Well, good day, traders. My name's Chris Weston. I'm head of research here at Pepperstone. I want to talk to you again about the gold market and the investment backdrop that we're in. We've seen huge volumes coming through the desks, as you'd imagine, in terms of gold. Not just in US dollar terms, but I think also in euro terms and also in Aussie dollar terms. Gold's been one that I think has mystified a few people last week. I think if you go back to some of the calls I was making last week, I was suggesting that gold in US dollar terms was a good buy through 1660. I still stand by that one. We didn't really see that. In fact, we've seen gold really being offered into 1649. There does seem to be someone selling into those kind of levels at the moment. So I really want the gold market to push me and compel me into a trade. I think through 1660, I stand by that call. We wanted to look at gold more optimistically on a weekly close, but above 2,500 in the Aussie dollar terms. We did get above 2,500. In fact, we closed there. We didn't close the week above that level. It was a very slight close above there in Aussie dollar terms, 25.02. I think we got to. We got back down to 2,400. We've come back to sort of 20 pips shy, 20 points shy of those levels. So I'd certainly be taking that one off the table at the moment for a very small loss, but I'm waiting for the Aussie dollar price to confirm a little bit there, because we are starting to see a little bit of strength coming through in the Aussie dollar. So when we are looking at gold, it's not just about whether we see attractions in gold in the investment climate that we've got and the macro backdrop, but also, how can we maximize those profits by being long gold in the weakest currency or the perception of the weakest currency, or if you want to short gold, if you take a more bearish structure and take that for a trade, you want to be short gold in what you consider to be the strongest currency as well. So we want to keep a firm eye on that double-edged sword. What is the direction you like to trade gold in, and what is the currency that you want to do it in as well? If we have a look at the currency markets over the last 5 days, you can see that the euro and the yen have been the best performers against the US dollar. Why? Because implied vols are so high at the moment. Everyone was piling into the carry trade going until until the 19th or 20th of February. People wanted to see those grinding higher equity markets, very tight credit spreads, very low implied volatility. In that environment, people then, as soon as volatility hit us and it hit us hard, we saw people unwinding those carry trades. Really, the euro benefiting from there because it was the natural preeminent funding currency. So the euro's done very nicely in the last 5 days, up 2.7%. One of the best performing currencies. So buying gold in euros has been a very tough trade. Buying gold in yen has also been a very tough trade. I personally believe that I certainly wouldn't be looking to fade euros at the moment, just given what we're seeing from implied volatility. Until implied vols really start heading lower, I would be looking quite favourably at euro, although I am quite concerned about what's happening in Europe. If you have a look at the spread of the coronavirus, it's really centred at the moment in 3 countries specifically: one, Korea, Italy, and also Iran. And what's happening in Italy, we haven't really seen much of a move in Italian spreads against German bunds. But if you do have a look at the European banking index, now of course this does take German banks and French banks. Now this is one that a lot of the bears are looking at the moment. We've broken through this flag. We're looking to go back down to the 2016, 2012 lows. It looks like it's wanting to test them. What is going to be that circuit breaker? If we do see a break of that level, maybe that's going to be down to the weakness we're seeing there. Maybe it's down to the idea that the ECB are going to have to cut rates. I don't think the ECB are going to cut rates, but I think they're going to do more on liquidity. Christine Lagarde's made that obvious. But I think if we do get a break in those 2016 lows, I think the euro will become a concerning currency once again. But at the moment, we're focused very much on this idea about carry. So higher vols, you want to be long euros because basically people are unwinding that carry trade there as well. So what do we look at in terms of the gold, in terms of the currency? Well, it seems that the Aussie dollar is an interesting one. That's been flat. We have seen a bit of outperformance last couple of days in Aussie dollar gold, and Aussie dollar relative to the greenback. But we're watching what's happening in US dollar gold. I think that's the currency that you want to look at most prominently as we go through the new week. That said, if you have a look at the rates market, I think this is a really interesting one. Have a look at this rates chart. I want to invite you to have a look at the sort of centre one, which is implied policy, and look at that 1Y, 1 year. So this is the market, this is the swaps market's pricing of rate settings across all these different major central banks over 12 months. Have a look at Australia. This is absolutely fascinating. Obviously, we saw the Reserve Bank cutting by 25 basis points, but the market is now seeing this sitting in 1 year's time with a negative 11 basis point yield. Now, the RBA are not going to cut to negative rates, in my opinion. I think they've said the hurdle to do so is incredibly high. Philip Lowe, the Reserve Bank governor, chaired a piece which was put out through the Bank of International Settlements back in November, talking about the policy paths which he's studied in central banks from abroad. And he's made the case that QE is something that they're looking quite favourably on, that didn't have as many negative consequences. In fact, he saw some positives playing through. But he did see quite a lot of negatives around negative rates. Now, we're not going to see negative rates here in Australia, but we are going to see, I think, quantitative easing. That, at the moment, is a very high hurdle. And the fact that we're down at negative 11 basis points tells you the market is pricing in quantitative easing to be announced in Australia now. We got priced in 61 basis points. That's on top of the 25 basis points that we got yesterday as well. So that's a really interesting dynamic that is playing through in these rates market. Have a look at in the US, you can see the market's discounting the Fed funds rate to get down to 49 basis points. So, you're expecting over 2 more rate cuts to come through. If you look at the next meeting that's going to take place, the market's expecting a pretty good chance we're going to get 50 basis points cut. We obviously saw the Federal Reserve coming out with that unannounced, that emergency meeting last night, talking about a 50 basis point cut there. They've done that. That's the first time we've seen an emergency meeting since 2008, October 2008. So, the market has thrown a bit of a wobbly. If the Fed are concerned, perhaps we should be concerned as well. So if you look at the rate settings, it's a sea of red. The market's expecting pretty big central bank action. But, if you go into Australia, I think that's a really interesting one. But we're not seeing that weakness necessarily in the Aussie dollar at this stage. I think we need to see that being justified. Have a look at why we've seen these rate cuts coming through. The top pane shows the financial conditions index from Bloomberg, which marries everything together. It sort of aggregates things like the S&P. It marries implied volatility, interest rates, money markets, and various factors as well. And you can see it absolutely collapsed. Now, the Fed have said that Loretta Mester's come out this morning saying that they're not dictated to by the markets. I tend to disagree by that. The Fed really had absolutely no choice but to cut 50 basis points. They had a gun against their head by the market, and if they hadn't pulled it, then that would have caused even more negative consequences. So the Fed, while they're cutting rates, and other central banks will cut rates, but we'll see the Bank of Canada coming out tonight. They'll probably cut rates by 25 basis points. Yeah, fine, a rate cut's probably going to do absolutely nothing in this environment. It's going to do very little to stave off what is this rampant outbreak across the world. 76 countries now have got the coronavirus. We're seeing that rate really accelerating through Italy, through Korea, through Iran, as I say, and we're seeing the number of deaths really moving up. Not markedly, but they are increasing in the US, and it's something we've got our eye on. People's behaviours are changing, and that's something that we are seeing in economics. But if they hadn't cut, then I suspect equity markets and financial conditions would tighten even more. Have a look at the lower pane. You can see five-year break-evens. This is inflation expectations in the US. These have been falling through the floor. So the Fed, again, looking at that, didn't really have any choice, and we're going to see another rate cut, perhaps even 50 basis point cut when the Fed meet at the next central bank meeting. Now have a look at the influence that the S&P is having this. So so if we're thinking that gold prices are being supported by changes in rate cut expectations, have a look at this chart here where you can see that the white line, which you can see on the right hand axis, the number of rate cuts that are being priced in by the Fed funds future against the S&P, and it was really when the China started shutting down factories and people were getting restrained from going to work, and people were saying, there's going to be a supply disruption coming through, that we saw the number of rate cuts really following the S&P. S&P coming down, printing that double bottom that you can see on the chart there. But you can see now that the number of rate cuts are being dictated to by the S&P. The algos are really tracking what's happened on the S&P now. So if the S&P, for whatever reason, has a big rally from here, you'd imagine the number of rate cuts are being priced out. You can see at the moment, by the June FOMC meeting, we're pricing in 2.3 rate cuts coming through. And that is following really the S&P. So if the S&P rolls over, goes further lower, you're going to expect to see further, more aggressive rate cuts. But there's only so much that the Federal Reserve can do. So we are watching now. If we believe that the gold price is being kind of following really the number of rate cuts and what's happening in Fed funds future, well, you can clearly see for me that the S&P seems to be driving that. So the S&P is probably driving the gold price there as well. Have a look at real yield. The bond market has been absolutely staggering. You've been seeing absolute monster moves coming through. Nominals have been getting absolutely hammered in terms of yield. obviously very, very strong buying. Have a look at real yield. If you inflation adjust that, you can see the red number now, negative 44 basis points. It was part of the reason for my bullish gold call last week that I thought we were going to see lower real yields. That's played out. Gold obviously last week was being liquidated to take place for other positions. Hadn't been anticipating that, but we've got that flushed out the system, and I think gold prices have staged a nice return. If we do see volatility pick up and equities really coming under pressure again, yeah, we could see a rerun of this idea of selling gold to pay for other asset classes. People want cash to do that, so that may be something. But in terms of the backdrop at the moment, let's go through the backdrop. Real yields are falling very, very hard. Now they're overbought. Bond markets are massively overbought, but you can see now that correlation has once again reassumed itself. If real yields are going down to negative 50 basis points, negative 60 basis points, one would suspect that US dollar gold price is going to go back above 1,660 and perhaps even make a merry march onto that 1,700 level. So we're watching that correlation with the bond market. The bond market right now is just on absolute fire. If you haven't got some fixed income within your superannuation, you're clearly missing a trick now. Have a look at what's happening in that pool of negative yielding debt. It's not just in the US, but we're seeing the bonds across the whole world really finding good buyers in this backdrop that we're seeing. Even though the Federal Reserve, other central banks are coming to market and meeting the market. In the case of the Fed, they're going above and beyond. That pool of negative yielding debt, the total pool of negative yielding debt sits at $14.2 trillion. I believe that's probably going to go back up. You can see that the pool of negative yielding debt in the top pane being that yellowy kind of line. Gold price sort of going along with that. Now the correlation's not brilliant, but I do believe that if we start pushing back up to $17 trillion, which is the sort of levels we saw back in sort of September 2019, the gold price will go along with it. Have a look at the ratio of all bonds with negative yields. You can see that's 24%. So 24% of all bonds that have been issued by governments that are trading in the secondary market have a negative yield. If that percentage of all yields goes back up to sort of 30%, the gold price will go. So we are watching the bond market very, very closely in that regard. Now let's have a look at sentiment towards gold. So we know that rates markets are pricing in very aggressive cuts. The bond market's been very, very strong, very, very overloved to an extent, and the gold price has found solace in that. But let's have a look at sentiment. I go back to my volatility and the options market very closely in this. I think this is probably for me one of the best reviews of the gold price in terms of sentiment. The bottom chart I love, whether you're in the equity market, fixed income market, having a look at the difference between 25 delta 1 month call volatility relative to put volatility tells you so much about the demand for where people see the direction going and the propensity for that direction to move. But what we're seeing here is what we call risk reversals. So we're looking at 25 delta 1 month expiry gold options, and we're looking at 1 month implied volatility minus 1 month put volatility. And right now you can see that call volatility, the right to buy or bullish structures, is trading at 3.4 vols at a premium to puts. Now I've got the long run average there, since I've got since 2007, and you can see that with that blue line going through the middle, which sits at 0.026. So that's the premium. So naturally we do see gold calls trading at a premium to puts. But now we're getting into that sort of 2 standard deviation. So there is a lot of love for gold at the moment. The market is speculating that if we're going to see a move, it's going to be a greater move to the upside than to the downside. But we're not. Are we at the extremities? I'd be a bit more cognizant to be a bit careful above 4. But the bond market's telling you now that if we're going to see a move, it's going to be a greater move to the upside than the downside. But we're not at euphoric levels at the moment. You can see in the top pane where I've looked at the difference between short-term vol and long-term vol. So 1 month minus 1 year implied volatility in gold. This is through the optionality, and you can see that's been spiking up. It looks a little bit like the VIX, to be honest, but you can see that short-term volatility has really ramped up. So people are betting that we are going to see an aggressive move in the short term. We're not at overzealous levels at the moment, but you can see that people are on edge for a big move in gold, and that move's going to come in the short term. Have a look at positioning as well. We look at managed money in futures. You can see that we're sitting sitting in 231 net long contracts. We're one standard deviation above the sort of long-term average, but we're not at levels where I'm too concerned. Yeah, like, you know, we are at very over-owned levels in gold, but we're not at levels where I'm going to start suggesting solely using the commitment of traders report to go short gold. Net long positions have been increasing, shorts have been declining a little bit. We're at 231. We're at pretty high levels, but it's not nosebleed sort of territory at the moment. So we're watching what happens in the coronavirus. We continue to watch this spread going out of China, although China, to be fair, is actually looking like they may have got things under control, and we may be looking at a much more positive picture as we go into the back end of March. But we're looking at what's happening in Italy, we're watching what's happening in Korea, we're looking at what's happening in the UK and also parts of Europe and the US. And we're wondering how this is going to change people's behaviours. What's this going to happen on economics, and what's going to be the further central bank response? The markets are pricing in very aggressive action. Equity markets have got quite worried about the message that we're hearing from central banks, and I think equity markets are quite spooked by the idea that they probably won't have much effect on economics in the first place. People are not going to stop going to work because they're getting cheaper interest rates, and you know, the consumption and all those various factors are going to get taken into place. So central banks are probably unlikely to do this. This is not the GFC. This is not a banking crisis. This is not a liquidity crisis. This is an economic fragility crisis at the moment, and it's not necessarily going to get solved by interest rates. And I think the equity market's quite worried about that. I think the gold price will probably start reflecting that soon. So we're still looking quite favourably at gold. We're looking at that bond market and find further buyers until we see the bond market sell off aggressively. You know, we want to take a more favourable bias on gold. So we're looking at gold in US dollar terms, breaking through 16.49. We turn a little bit more bullish. Through 16.60, I think I'll probably be looking at much active long positions there.